Howdy there, folks. Welcome into today's video. I'm going to react to a bunch of news and different things that happen in regards to some stocks I personally own in this video. Nike, we're going to speak about Nike in this video. They just got upgraded. This is a stock I bought, I think it's 7 straight weeks now at this point in time. So we're going to speak about that. Then this survey came out of teenagers, Celsius, Starbucks, McDonald's, Elf, Nike, all these different brands, and we'll talk about the results of that, why it's important, those sorts of things in this video. Okay, I want to react to this one here, which is essentially Sofi coverage, getting upgraded to a buy from this analyst here. Then we're going to get into this one. Amazon, Andy Jassy sent out basically a shareholder letter here today, and so he spoke about AWS. Want to react to that, and then also talked about consumers trading down as a giant corporation like Amazon is. They got I think the most intel on what's going on in the real world out there. And then I want to lastly talk about this Apple sentiment situation, kind of Apple stock, and kind of my views there and react to that there, okay? Appreciate everybody joining me as always. Thanks so much for being here, folks. I want to get straight into this. Smash the thumbs up. Make sure you're subscribed, and the one-day sale 3 days away pinned comment for access for that, okay? So Nike rallies after Bank of America says product innovation will boost shares. Nike's tracked higher in early trading on Thursday after Bank of America upgraded the athletic apparel stock to a buy rating after having it set at a neutral. Okay, so they're going bullish now. This analyst, Hutchinson, said consensus estimates for Nike finally look achievable. Quote, Nike is taking bold steps to transform, and the stock sits at a 10-year trough relative PE, she highlighted. 100%. The thing that's so beautiful about Nike is it's such a safe corporation to invest in, one, right? And two, when you're investing at this sort of valuation, it just is overwhelmingly attractive as a buy, which explains why I bought this stock 7 straight weeks now at this point in time, right? Hutchinson, and I probably will buy 8 straight weeks and 9 and 10 and 11. Hutchinson expects Nike to ramp up innovation ahead of the Olympics, which the Olympics are this summer, and its Investor Day event, which will happen for the first time in 7 years this fall. The event is seen generating demand and excitement around the company's products. Bank of America said modeling accelerating demand creation spending for Nike to generate excitement over its new products. Nike is also noted by Bank of America to be undergoing a broad restructuring, which is expected to pay off on the bottom line over the next 2 years. Boom, that's the huge point with Nike. Outside of the great brand, outside of where the stock's trading at compared to where it usually trades at, right? The other huge thing here is this restructuring we're talking about $2 billion of cost savings. That's all going to hit the bottom line. And Nike's fiscal year ends in May, so you're really going to start to see that come in fiscal year 25, which once again starts after May, and in future years as well. So that's another part that just makes this Nike case so dang attractive. Seeking Alpha analyst Grant issued a buy call on Nike earlier this month, expects Nike's brand to see a resurgence in strength by the end of 2024 or the beginning of 2025. So obviously this stock is up on the back of this news, and yeah, I remain very, very excited about Nike. It's just easy money. I just love it when I can buy stock and it's easy, right? Some stocks I buy sometimes and it's like, they might have insane upside potential, but they're a little risky, right? And, there's that excitement of like, wow, this could be a 5x, 10x, 20x opportunity. That's not Nike. But Nike's just like, I'm investing in that. It's easy money. I'm going to make dividend money off that. I'm going to make nice share appreciation over the coming years. Easy, easy, easy. So some of those stocks are just beautiful to have in your portfolio. Celsius, Starbucks, McDonald's, and Elf Beauty stand out in a survey of teenagers. Piper Sandler released its 47th annual Taking Stock with Teens survey on Tuesday. In footwear, Nike remained the overall favorite footwear brand, but the company's mind share from a year ago as New Balance made a big jump. New Balance? I don't know if that's lasting, but whatever. Nike's Converse brand had lost the most footwear mind share over the last year. Decker's Hoka brand and On Running also gained market share. It doesn't surprise me at all. Those brands have been really hot last, I would say, couple years here. We'll see if they remain hot over the next 5-10 years. It's a long-term gain, right? In cosmetics and beauty, Elf widened its dominant position with teenagers, while Sephora outperformed Ulta Beauty. Beauty consumers still prefer to shop in-store versus online, Piper Sandler survey. So I think that's important. So, it's surprising. Like some people still like to shop for certain items in a store versus online. And beauty consumers are one of those. I think shoe consumers would be another one, right? A lot of people like to try on the shoes, buy them at an actual store rather than online. Notably, Target improved its standing with teenagers in the survey. I'm not surprised at all in regards to that, right? And Target could be stealing a little bit of market share here and there from Ulta. You never know, right? Especially after what Ulta said here recently. Now, great, obviously, to see e.l.f. It doesn't surprise me at all, no, because e.l.f.'s the most successful by a large margin when it comes to cosmetics category on, TikTok, Instagram, all the big social platforms, so it doesn't come as a surprise at all. There was a notable shakeup in the restaurant preference ranking of teenagers. Chick-fil-A remained the favorite restaurant at 16% share, but McDonald's jumped to number 2 spot, and Chipotle slotted in the third favorite restaurant pick. Raising Cane's also ranked much higher than a year ago. Yeah, Raising Cane's, if it was across the nation, believe me, Raising Cane's will probably be number 1 overall then when it comes to teenagers. So interesting. By the way, let me just tell everybody why this is important. You might say, teenagers, who cares about what teenagers? Teenagers don't have any money, right? Who cares? Here's why. Here's why Wall Street pays attention to this. So here's why they do the surveys. They do this because, you're 17, 16, 18 years old. You're about to go into likely college, right? Graduate, get your job, start making more money, obviously, and spending money. And you enter, the workforce, and boom, you become a consumer, right? And so the thought process is you want to try to get people to love your brand, kids to love your brand as teenagers, and then hopefully once they get to their money in their 20s and 30s, they're loyal to your brand. So let's say in e.l.f. Cosmetics, for instance, right? You attract them as, somebody that's, 15, 16, 17 years old. And hopefully when they go to college, they're going to be using your product. And then when they graduate from college and they enter the workforce, they're going to be using your product, right? And the same thing goes for all those brands, right? And so that's why it's important. Do teenagers have a lot of money? No, we know that. It's not about necessarily them spending right now. It's more about what they're going to be spending in the future, making sure they like your brand, they're in your ecosystem, those sorts of things, okay? In snacking, Campbell's Soup, Goldfish topped the list. Interesting, okay. I would think that's number 1 amongst maybe 2-year-olds, but okay, teenagers as well. Followed by PepsiCo's Lay's and Kellogg's Cheez-It. Cheez-Its? Teenagers like Cheez-Its? I thought only my mom liked Cheez-Its. That's wild. Celsius was one of the biggest standouts in the teenager survey. At 17%, cited the Celsius brand as their favorite energy drink brand versus 12% market share. Monster and Red Bull both under-indexed with teenagers in comparison to their total market share, so not great for those two brands, obviously, right? Very good news in regards to Celsius, and does it come as a surprise? No. I mean, Celsius has just they've been outflanking Monster and Red Bull, and then obviously all the other energy drink brands, but it's just Monster and Red Bull is the main competitive threat. So Celsius doing a heck of a job, and obviously it pays in their stock price. They're one of the few stocks that's outperformed e.l.f. over the last 5 years. Very few. That's really the only stock I can think of that's outperformed e.l.f. in the last 5 years. Starbucks and Bath & Body Works also have dominant market share positions, mind share with teenagers. Our survey results indicate a slight increase in teens spending sequentially from fall of 2023, but self-reported spend is down 6% year over year, well below pre-Rona levels. We are seeing some significant shifts in brand preferences, including the rise of smaller, innovative brands, which are taking share from incumbents. We think social media has led to an accelerated trend cycle, including an increased emphasis on key products in brands that will have to be nimble to keep up. Yeah, and a lot of brands just aren't very nimble, so they can't keep up, especially with companies like the e.l.f.s, right? So, interesting about spending there. And if we think about, and I'm looking forward to getting a Sofi, Amazon, Apple here, but if we think about, like I'm trying to think back to when I was, let's say 17, 18 years old, what were my biggest expenses back in those days? My biggest expenses were gas for my car, because I drove this old car that is a 1977 and got less than 10 miles a gallon. My other big expense was my cell phone bill. And my other big expense from what I remember back then was car insurance. Now, if we think about some of those categories, we have definitely seen some major inflation in some of those categories, right? Car insurance, I mean, that was the hottest thing by far and away in the CPI numbers yesterday, right? So 17, 18-year-olds, I'm sure it's not fun to pay car insurance rates right now if you have to come out with that out of pocket, right? And then if we think about gas prices, pretty dang high right now. So that's something that's negatively affecting out there. So yeah, I could see that. And then, back in my day, we used to get cell phones for free because back in those days, it was like the flip phone days, right? So you didn't even have to worry about spending $1,000 on an iPhone or whatever. The cell phone bill is more expensive than it was back in my day, but, it's not like it's an insane amount more. But compared to getting a free phone versus, now you buy a $1,000 phone is, that's a pretty big expense as well. So I understand, why teen spending might be down with inflation going on, right? Citi resumes SoFi coverage at buy after model update financing actions. Citi resumed coverage of SoFi with a buy high-risk rating. Interesting way of putting that. Okay, a buy high-risk rating, as this analyst takes into account the lender's recent financing actions that are expected to save $40 million, $60 million in annual interest expense and dividend payments. Love it. Love it. SoFi exchanged $600 million of its 0% convertible senior notes due 2026 for 73 million shares, which should benefit the total risk-based capital ratio and add Q1 generally accepted accounting principles income. Should add to it. So that's good. The analyst said also it issued 1.25% convertible senior notes due 2029 and entered into capped call transactions. Quote, our fundamental bullish view on SoFi remains unchanged, especially as its intended business's diversification comes into focus. Its ability to continue to attract deposits, continue to prove itself out, and investors focus on the forward profitability, he wrote to clients. Yeah, I think SoFi's doing a great job attracting a lot of new customers, right? Their savings account product is attracting a lot of people. It's really trying to get people in the ecosystem of direct deposit and then getting that rate. And then their personal loans are really attracting a lot of customers, in my opinion, as well. Citi analysts expect SoFi to continue tightening personal loan underwriting until delinquency rates improve. Good. Possibly in the second half of 2024. He estimates 6% origination growth in 2025. He sees student loan refinancing originating ticking up late this year as a 12-month on-ramp that the government implemented when restating a student loan payment expires. Yes, that's still coming. I mean, when you think about student loans, some people have started repaying them, but others are still actually not paying them right now, which is fascinating. It's the whole situation. His model's estimates for end of period loan balances calculates growth of 9% for both 2024 and 2025, assuming relatively stable payment rates and higher loan sales activities. We increase our net interest margin expectations for the next 2 years as we anticipate the company will continue to replace higher cost funding with lower cost deposits. He also sees higher financial services segment revenue reflecting strong trends in credit, fast-growing payment network fees. So, my opinion on SoFi, obviously you guys know it's a relatively new stock I've been buying, right? My opinion on SoFi is I think it has an extremely attractive risk-reward profile, especially at $7. Here's the deal, okay? If we ever have a big unemployment, nasty recession, it's going to hurt SoFi, right? That's true for all banks. So it's just a risk you have to be willing to take, right? In regards to these. Now, if you don't, I think SoFi's looking great. It's looking really, really great. They have such a wide range of products now. They're really, Anthony Noto really has that team running on a high level in terms of understanding how to steal away future customers. We spoke about teenagers earlier in this video, right? And I just think SoFi is a very attractive product for teenagers or those people that are getting their first bank accounts, much more so than traditionally a Wells Fargo was. Or I remember going down to the bank when I was a teenager with my mom, and we set up my bank account, right, with direct deposit. When I got my first official job at Einstein Bagels cleaning dishes. I remember that, right? And I just think SoFi is really attracting the people that were me 15, 16, 17 years ago. And they're doing that now. And I think they're going to continue to do that over this next 5, 10 years. And I think a company like SoFi relates a lot better to the younger consumer than some of these older traditional banks do. So, yeah, I think that really bodes well for SoFi's next many years in front of it, right? I do think SoFi is also, and not many people ever talk about this, and I'm not sure why, because it's very common in this industry. I think SoFi is a very attractive takeout target in terms of a buyout candidate. So meaning a big bank buying a company like SoFi and really getting that digital experience. Now, would Noto, the board of directors, and shareholders want to sell the company? I don't think so. But if I was a big bank, right, and I don't have a big digital presence like that, and I'm kind of old school, a lot of locations, I would look at a SoFi, try to buy out SoFi, even if I've got to pay double the price, even if I got to pay $14 a share, $15 a share. I think it's a very attractive opportunity when you look at what's going on there. So now for SoFi shareholders, I hope that doesn't happen because, I think a lot of the SoFi shareholders want a whole lot more than $14 or $15 for this company over time. So that's a little food for thought in regards to that. But there's no doubt that it'd be, why wouldn't you try to buy it if you're a Wells Fargo or a Bank of America, right? You're just getting such a differentiated product mix. I don't know. I think it's a really attractive. And in the banking industry, banks buy banks all the time. Big banks buy little banks. I don't know, man. We'll see. Amazon's Jassy touts AWS Kuiper opportunities, says generative AI is the next pillar. Amazon CEO Andy Jassy published his annual letter to shareholders on Thursday and touted the rebound in cloud computing. And said, I like that, touted the rebound in cloud computing and said generative artificial intelligence is the next pillar. The 56-year-old Jassy, who took over the company's founder, Jeff Bezos, in 2021, said AWS ended the year on a strong note after customers were worried about costs for much of 2023. By the end of 2023, we saw cost optimization attenuating, which basically just means chilling, new deals accelerating, customers renewing at larger commitments over longer time periods, and migrations growing again. That's great news. Revenue attributed to AWS increased 13% year over year to $91 billion in 2023, up from $80 billion in 2022. Satellite internet opportunity, Project Kuiper, Amazon's satellite broadband internet initiative, was also highlighted in the letter as Jassy called it a very large revenue opportunity for the company. We're on track to launch our first production satellites in 2024, Jassy wrote. We still got a long way to go, but we're encouraged by our progress. The company launched 2 end-to-end prototype satellites in space in October. 2 months later, Amazon said it had successfully completed tests of optical mesh networks of laser links between Project Kuiper internet satellites in low Earth orbit. Project Kuiper, which competes with other satellite services such as obviously SpaceX, Starlink, is Amazon's low Earth orbit satellite initiative. It aims to provide broadband connectivity to 400 to 500 million households that don't currently have it, as well as providing better connectivity in remote areas. Big stuff, man. Big stuff. Next pillar of growth. Jassy talked up artificial intelligence in his 2023 letter to shareholders, but now believes generative AI will be the company's next pillar. While we're building on a substantial number of Gen AI applications ourselves, the vast majority will ultimately be built by other companies, Jassy wrote. However, what we're building in AWS is not just a compelling app or foundation model. Amazon has 3 pillars or areas it describes as the most successful businesses: retail, prime, and cloud computing. He added that AWS's service will hit 3 layers of the stack, building foundation models, leveraging foundation models in the application layers, quote, comprise a set of primitives? That's comprise a set of primitives that democratize this next seminal phase of AI and will empower internal and external builders to transform virtually every customer experience that we know and invent altogether new ones as well. We're optimistic that much of this world changing to AI will be built on the top of AWS. Yeah, I mean, I don't doubt it, right? I don't doubt it at all. I mean, much of the world is built on AWS. Obviously, the main competitor is Azure from Microsoft, and outside of that, it's kind of just a joke, right? Google's further down off that. You obviously have Oracle Cloud and a few others, but they're all just minuscule. It's really just AWS and Microsoft in the end of the day. Andy Jassy said consumers are trading down on average selling prices. In a CNBC interview, Jassy said consumers are spending, but are really careful about what they spend on and how much they spend. Consumers, he said, quote, whenever they can find a deal, they take the deal. However, the everyday essentials business has had 20% growth year over year in the fourth quarter of last year. It's going to take a lot of people to not to buy detergent or shampoo or things like that. He also said that where he has seen the real impact of inflation is in discretionary items such as TVs, computers, and other electronics. Quote, we're growing our market segment share at faster rate than others, but still at a slower rate than what we see in a healthy economy. Interesting. Which is basically Andy Jassy's way of saying we're not in a healthy economy. That's interesting, right? It's basically just Andy Jassy saying we're not in a healthy economy. On the enterprise side, he added, during the last couple of years, companies have tried to save money however they could. This has been seen in Amazon Web Services. I think a lot of that cost optimization has been attenuated, he said. And we've seen a lot of deals that people were talking about with us for a long time, which were sitting on the back burner, starting to move, which is good, right? It goes from just, people talking about it to actually, let's sign the contract, let's actually get this done. Jassy said there's a full pipeline of e-commerce enterprises migrating from largely trying to save costs to figure out how to modernize their infrastructure again, moving from on-premises to cloud storage and thinking about how they can use generative AI to change their business. So, Amazon executing well as always. Apple sentiment improving despite relatively low growth outlook from JP Morgan. Apple appears to be gaining traction among hedge funds investors despite issues with fundamentals as a tech titan appears ready to begin its entry into artificial intelligence. Oh gosh, we'll see. Quote, contrary to the deterioration of the fundamentals relative to both hardware demand as well as outlook and services growth, the interest in Apple shares have improved from the broader group of investors who have otherwise been averse to the premium valuation multiple despite one of the lowest growth outlooks relative to other mega cap techs. That's the thing. Like Apple for 2024, it's a question if they're ever going to grow their business. That's the thing. It's like, is Apple even going to grow the business in 2024? I think that's a serious question. I don't know. If they do, it's going to be maybe a few percent at the max, right? Versus a Meta, which is going to have very strong growth this year. Amazon's going to have very strong growth this year. NVIDIA's going to have ridiculous growth this year, right? Google's going to have nice growth this year. Microsoft's going to have nice growth this year. So only two of the Mag 7 are Apple and Tesla, right? That are seen as like maybe they don't grow their business this year. Maybe their business is kind of flattish, right? Despite these issues, Apple's ever-popular iPhone is set to begin an AI upgrade cycle, which could lead to the same momentum Apple experienced in the 5G upgrade cycle. Part of this is due to the lack of backward compatibility, which should accelerate the replacement cycle, much like 5G capabilities. So they upgraded it to $215, right? Or they lowered their price target even though they're overweight. That's wild. So they're overweight, but yet they lowered their price target to $210 from $215. That's crazy. But here's the deal with Apple, right? AI. I don't see that necessarily being a game changer anytime soon for Apple, right? If it ever is, but certainly not short term. There's one thing that's a game changer for Apple that will be likely coming in September, and that is, guess what? It's a huge innovation from Apple. It's a bigger iPhone. The big innovation, it will be here in September. It's a bigger iPhone. And if what I've been hearing is accurate, and they do come out with that bigger iPhone in September, it's going to bode great for Apple sales of iPhones next year. Okay? So, that's a big innovation. Is AI going to, I don't think Apple's going to do anything. AI is going to make everybody say, I got to go get this new iPhone. No. But, a bigger iPhone, and people will say, oh my gosh, I got to get it's even bigger than the previous one. I got to go get it. Apple, every time they come out with a bigger iPhone, there's usually always a big bull cycle for a year or two. And that's what you'll see play out likely in this situation as well. Okay. Hope you guys enjoyed today's video. I appreciate y'all joining me. As always, thanks so much for being here. Also, we are now only 3 days away from the massive sale, 3 days and 15 hours. Pin comment down there. Get access to my #1 course ever. So if you're somebody that's in your first 3 years of investing and need to know everything you need to know about financial statements, value in stocks, if you're getting ripped off, if you're getting a great deal, you need access to that course, access to see the moves I'm making each week, which I will be making moves in that portfolio tomorrow, and also the Discord chat that's in the Patreon. It's usually $125 that tier. For that 1 day, it's going to be $69. So enter your info with the pinned comment down there. We'll send over that deal when it drops. Much love and have a great day.